If you've ever thought about keeping your starter home as a rental or buying a second property to build some financial security, there is a massive change coming in 2026 that you need to hear about. A new federal mortgage rule is about to make it much harder for regular Canadians to qualify for another home, even if you can clearly afford it. And here's the part that should make you question things. This doesn't apply to big institutional investors. It only applies to everyday people like you and me. Today, I'm breaking down exactly what's changing, who it impacts, and what you can do right now to protect your options before this door closes. Hey, what's going on, everybody? I am Tristan, a full-time realtor here in Edmonton, and my goal is simple: to help you make smart real estate moves backed by numbers, not emotion. Today, I'm breaking down exactly what's changing, who it impacts, and how to protect your options before 2026 hits. And the frustrating part? This rule doesn't apply to big investors, just regular Canadians trying to build stability. So let's get into it. All right, here's what's actually going on. In Canada, mortgages are regulated by something called the OSFI. That's the Office of the Superintendent of Financial Institutions. They're the ones who decide how banks assess your risk, how much income you can use to qualify, and basically how much real estate you're allowed to buy based on your debt and income. Starting in 2026, they're introducing a new guideline that completely changes how rental income is treated when applying for another mortgage. Up until now, if you owned one home and you were renting it out, your lender could use part of the rental income to help you qualify for the next property. That's about to change. Under this new rule, once you've used your personal income and rental income to qualify for one mortgage, you can't reuse the same income again to qualify for the next. And before you think, well, that's just rental income, my job income should be fine, here's the thing. OSFI hasn't been totally clear on where the line stops. From what we know, their goal is to prevent double counting income, meaning if your income has already been used to qualify for one mortgage, it may not be counted again the same way for your next. That could include your salary as well. We don't know exactly how banks will interpret this yet, but either way, the message is clear. The same dollar of income can't qualify for multiple mortgages. So even if it's not fully confirmed for employment income, the logic OSFI is using suggests we're heading in that direction. So who actually gets hit by this new rule and who doesn't? Let's start with the people it does affect. Everyday Canadians who are just trying to build a bit more financial stability for their family. That means first-time buyers who want to keep their starter home as a rental when they move up buyers who'd rather rent out their old place instead of selling it right away, and small investors who worked hard, saved up, and are hoping to buy 2 or 3 properties over time. Not to get rich quick, but to create long-term security. These are the people who are going to feel this the most. Because if your lender can't reuse that rental income that you relied on the first time around, your buying power for the next property could drop by hundreds of thousands of dollars. Let's say you buy a duplex. You use your job income and a bit of rental income to qualify. Pretty standard setup. A year later, you're ready to buy again. You've been paying everything on time, your rental is cash flowing, nothing about your finances has changed. But when you go back to your lender, they run the numbers and say, sorry, we already used that income once. And here's where it gets tricky. Under OSFI's 2026 guidelines, they're trying to prevent what they call double counting income. So even though you still earn that salary and you still receive that rent, the lender might not be allowed to count it the same way again. It's not that you suddenly make less money, it's that the system now treats that same income as already spoken for. Now here is where it gets frustrating because this rule doesn't apply equally to everyone. Big investors, the REITs, the pension-backed residential groups, the private equity funds, they're using corporate structure, and commercial lending. They don't need to qualify based on personal income the way that you do. So while you have to prove that you can afford a $500,000 duplex, a corporate investor can buy 200 of them, no problem. In plain English, if you're just trying to buy 1 or 2 homes to build some long-term security, the rules get tighter. But if you're buying an entire neighborhood as a corporate fund, then the door stays wide open. Now, here's what most people haven't even thought about yet. This change doesn't just impact people buying homes. It's going to ripple down and affect renters too. For years, small landlords, everyday Canadians who own maybe 1 or 2 homes have actually played a huge role in keeping the rental market flexible and fair. These are regular people. They know their tenants by name. They're more likely to work with you if you hit a rough patch, and they care about their property because it's their property. And they care about the people living it because they're part of that same community. But when policies like this make it harder for small landlords to buy or hold on to rental properties, those homes don't just disappear. They get scooped up by institutional investors. And when that happens, the entire tone of the rental market changes because a pension fund or a real estate investment trust isn't going to negotiate your rent when times are tough. They're not going to drop by to fix the door or shovel the walk. They're just going to send a work order. And every single decision gets made by a spreadsheet and not by a person. So while this rule was designed to prevent risk in the financial system, what it's really doing is pushing out the small players, the people who make housing more human. When the only landlords left are corporate ones, renters lose flexibility. The humanity disappears, and over time, the community does as well. So let's talk about the biggest mistake that people are making right now and how to avoid it. A lot of Canadians are qualifying for mortgages today using every single dollar of income they have. Personal income, rental income, sometimes even side hustle income. And on paper, that makes sense, right? You're maximizing your buying power. But here's the problem. If you stretch everything to qualify for your current property today, you could be locking yourself out of your next purchase down the road. Because when this new rule takes effect, that same income you use to qualify for your first property, your salary, your rental income, all of it, may already be counted. In the OSFI's eyes, it's already been used up. They call it preventing double counting income, meaning if that income helped you qualify for one mortgage, it can't automatically be used again for another. So let's play this out. Say you bought a home this year using your job income and $2,000 a month in rental income. Everything goes smoothly, the property's cash flowing, you've got tenants, you're managing it reasonably. Then, a year or 2 from now, you decide you want to grow. Maybe you're buying a second rental. Maybe you're moving and want to keep this one as an investment. Your lender runs the numbers again, and this time that same income doesn't count the way it did before. Even though you're earning it, and even though you've proven you can handle it, the system treats it as already spoken for. Suddenly, the home you could have easily qualified for last year is now completely out of reach. And here's the thing, it's not about whether you can afford another property. It's about whether the bank is allowed to see you as a safe bet under the OSFI's new risk model. That's what catches people off guard because it has nothing to do with how responsible you are. It's just the math. So the mistake to avoid right now is this. Don't max out your borrowing power without a long-term plan. Because under the new framework, what helps you qualify today could be the exact thing that limits you later. All right, let's talk solutions. Because while this new rule is real and it's coming, there are still smart ways to plan around it. The key is strategy, not panic. Here's what you can start doing right now to protect your options. First, book a mortgage strategy review. Most people only talk to their broker when they're actively buying. But if you're thinking about buying again in the next 12 to 24 months, you need to understand how this new rule could change your approval math. Because if OSFI is tightening how income is counted and your salary or rental income might not be reused once it's already been applied to another mortgage, your whole qualification picture could look very different next time. Second, if you're upgrading homes, consider using a bridge loan or sale proceeds instead of relying fully on rental income or salary to qualify. That can help you stay a little bit more flexible later on, especially if lenders start limiting how much of that income can be counted again. Third, talk to your mortgage professional about structuring your rental income as supplementary and not primary, meaning your file still looks strong even if that income gets restricted or discounted under these new rules. Fourth is keep your income ratios tight. That means managing your debt, avoiding unnecessary credit pulls, and keeping a healthy buffer between what you earn and what you owe. The less leveraged you are on paper, the more room you'll have to move when these new rules kick in. You can still grow your portfolio, but the strategy has to shift. People who start planning now are the ones who will keep moving when everyone else hits a wall. This isn't just a rule change, it's a shift in how Canadians build wealth. For decades, real estate has been one of the few reliable ways for everyday people to create financial stability, to build something that grows while they sleep. You'd work hard, buy a home, maybe rent it out later, and over time, build a little financial cushion for your family. And that model is being squeezed. And the timing couldn't be worse. Housing affordability is already stretched, and now the path to building long-term security through real estate is getting narrower for the people who actually need it the most. Meanwhile, big institutional investors, the funds, the REITs, the corporations, they're still buying in bulk. They're not limited by income tests or stress tests or rental reuse rules. They play on a different field. So what does that mean for the regular everyday Canadian? It means you have to play smarter. You have to understand the rules before they change and not after. Because the truth is, the people who win in real estate aren't the ones with the biggest paychecks. They're the ones who understand how the system works and how to plan around it. So while the rules might tighten, there's still opportunity for those who prepare early. In other words, regular Canadians have to play with less leverage, but big money still plays with full flexibility. So here's the bottom line. This 2026 mortgage rule might make qualifying for another property harder, but it doesn't mean the dream is over. It just means the game is changing. And truth is, smart planning and the right strategy will always beat panic and guesswork. If you understand how these rules work, you can still win. Because while the system might tighten, opportunity doesn't disappear, it just shifts. And the people who pay attention early are the ones who stay ahead when everyone else is scrambling. My goal with videos like this is simple: to help Canadians make smarter real estate moves backed by facts, not fear. So if this helped give you some clarity, hit that like button, share it with someone who's been talking about buying, and make sure to subscribe, because this channel is all about keeping you one step ahead of the market without all the noise.